Hi guys, welcome back. Today we'll be looking at Realty Income with its ticker symbol O. So Realty Income Corporation is a real estate investment trust that invests in freestanding single-tenant commercial properties in the United States, Puerto Rico, and United Kingdom as well. Burst onto the scene in 1994 when it was listed on the stock market, and since then the returns have been pretty solid. They're not great, especially if you compare them to many other companies that entered the stock market during this time, but it does pay more than 4% dividend yield, and it pays its dividend monthly as well. So it can be a very good conservative company to add to your portfolio that can make it a little more recession proof and can give you solid dividend yields over the next 20, 30, or 40 years. So Realty Income is a dividend aristocrat. It has consecutively increased its dividend for 28 years, and it calls itself the monthly dividend company. It focuses on triple net leases, develops single tenant standalone buildings, and enters into leases with financially stable tenants. For example, at the end of 2020, the top clients for Realty Income was Walgreens, FedEx, 7-Eleven, Dollar Tree, and Dollar General as well. All of these companies are very powerful brands, and they would be able to pay off their rent to Realty Income at a very secure rate. And that was seen even with the pandemic. They were collecting more than 94% of contractual rent, and the only part that was lagging behind were theaters, as it loans out to AMC as well. And due to the lockdowns, it was taking longer to recover. But despite this, they managed to collect more than 94% of rent, which is very solid compared to other REITs as well. And even during this time, throughout 2020, they increased their dividend twice, while many REITs were cutting their dividends during this time as well. So Realty Income is one of the largest players in the net lease space. It has more than 6,600 properties under its portfolio, which is massive, and this size is a very big benefit to Realty Income, as they could snowball this into buying more and more properties and increasing its portfolio that way as well. So it has put in pretty good numbers. The stock price is up more than 100% versus a gain of 67% for the average REIT, using the Vanguard Real Estate Index ETF as the standard REIT as well. So if you include the dividends as well, you're looking at a more than 212% cumulative return versus the average REIT of 150%. It is a dividend aristocrat with more than 25 years of annual dividend hikes under its belt. The current dividend yield is 4.2%, which is well more than 2.1% on offer by the average REIT as well. And Realty Income pays monthly dividend, as I mentioned previously, which makes it almost like a paycheck replacement. So that is a very positive sign there. On top of this, they have had an acquisition of Verit, which will push the combined portfolio to more than 10,300 properties. There are a couple of big benefits from the deal, and Realty Incomes believe that there will be a 10% accretive to the adjusted funds from operations. So first of all, there'll be savings when it comes to spreading costs over a larger portfolio. Secondly, investment grade rated Realty Income has lower debt financing cost. So as the very debt rolls over, there'll be additional cost savings there as well. And it also shows that they can take on larger transactions and are able to grow through acquisitions into the future as well. So now we'll be looking at their investor relations page. We can see it has a 15.3% compound annual total return since its 1994 listing, which is very, very solid if you look at annual return. Has a more than 4.4% of compound annual dividend growth since 1994, again very solid, and more than 612 monthly dividends paid, which is close to 28 years. Now we'll be looking at their investor presentation as well. So if we look at where they're going to be in the future, so currently they're an S&P 500 company. They're one of the 65 companies of the Dividend Aristocrats Index. They're a top 10 global REIT. They have a 15.2% compound annual shareholder return since 1994 and a 4.4% annual dividend growth and 110 dividend increases during this time as well. In the future, they're looking to be more than $50 billion global company as measured by enterprise value to consolidate the $12 trillion global net lease addressable market. They're trying to grow from a top 10 to a top 5 global REIT and to average double-digit shareholder return with minimal volatility, and to continue treating its dividend and increasing that into the future as well. So next thing we'll be looking at as their investment thesis. So they have a 15.2% compound annual total return since 1994, and they have a 0.4 beta versus S&P 500 since its 94 listing as well. They've consistently been increasing their dividends, a 4.4% compound annual dividend growth rate since 1994, and it's part of the dividend aristocrats as well. The stability and growth of its earnings, they've had 24 out of 25 years of positive earnings per share growth, which is amazing. And they have a 5.1% median AFO per share growth since 1996. So once again, a very, very good. Looking at future growth, they have more than 12 trillion in addressable market opportunity throughout the US and Europe as well, and 64 billion of sourced acquisition opportunities in 2020 alone. So if we look at this, Realty Income is a global leader in a highly fragmented net lease sector. So they have $32 billion in enterprise value, $1.7 billion of annualized base rent. They have an A3 or an A- credit rating by the Moody's and S&P. They have 52 years of operating history. They were established in 1969. They have more than 6,662 commercial real estate properties. Adding on to they have more than 10,000, and they have about 50% rent from investment grade clients. So they're the 9th largest global REIT. They're growing their international presence as well. They have a UK portfolio of more than 2.2 billion, 54 assets, 100% occupancy, and a 12 years remaining lease term, and they operate throughout 5 industries. If we look at their real estate portfolio, it's very diversified. They have more than 600 clients in more than 56 industries, more than 50 in the United States, Puerto Rico, and the UK. And 96% of total rent is resilient to economic downturns or isolated from e-commerce pressures that they have as a low price point or service-oriented retail business, which will be slightly more resistant to downturns coming into the future as well. They have a very strong dividend track record. They have more than 26 years of rising dividends, 610, now 611 monthly dividends declared, 94 consecutive quarterly increases, and the S&P 500, it's part of the dividend aristocrat there as well. So if we look into the future, they have a very attractive risk and reward. If we look at the S&P 500 companies and blue chip REITs, they have a beta of greater than 0.5, and their total return compound annual growth rate since 1994 is close to the 15%, which puts them in a very select group of companies. If we look at compared to purely the REIT peers, they have a beta of more than they have a beta of, once again, slightly higher than 0.5. And then they have a compound annual growth rate since 1994 of close to 15%, which once again puts it in a very select group of companies who are able to have a very attractive reward, but not too high risk in that way as well. So they had, in 1994, they had the 6th lowest of all the S&P 500 constituents, and now they have has a very high shareholder return, more than 20% with companies such as Johnson & Johnson, because they have very high earnings predictability, cash flow durability, and balance sheet quality here as well. So if we look at comparing it to its peers, they were one of the few companies that managed to make a profit or a growth in their earnings per share throughout 2020, with many of their net lease peers down 6.7%, their S&P 500 REIT peers down 6.8%, and their retail REIT peers down close to 19% there as well. So if we look at how they performed throughout 2020, in the financial year of 2019, they had more than 32.5 billion in enterprise value. Currently, they had that drop slightly with 32.1. They grew their annualized contract rent to more than 1.7 billion from 1.5 billion. Their available liquidity has once again increased by close to $200 million. Their fixed charge coverage ratio has increased by 0.8 times, which is their highest fixed charge coverage ratio in their history. and their total debt to market capitalization has slightly increased during this time as well. So if we look at this, we saw Realty Income had a very positive history. They've been continuously growing since 1994. They're looking to grow into the future as well, and they have a very resistant portfolio when it comes to their tenants, which makes it a very safe dividend aristocrat that you can just hold on to and just have the money roll in every month. So it seems like a very positive investment in that way. So we'll be looking at their stock chart over the last year. We can see the stock has been relatively volatile. It was down about $60, went all the way up to about 68, came all the way down to about $60, and is now trading at close to $70 now. If we look over basically since April to now, the stock has gone up to 70, come down to 65, gone up to 70, come down to 65, and up to 70 as well. So we're kind of seeing a roof develop here at close to $70. But during this time, we've seen the dips go from $60 to $65 to $67, and now it is trending upwards. So in the next few weeks, I wouldn't be surprised if the stock has a breakout. I would say the stock is a pretty good investment at close to $65 to $68. That seems like a good place to invest, slightly underneath the 50-day simple moving average. Overall, I believe this stock is very promising. It has doesn't have amazing future growth, but it has very good dividend growth as well, and a very solid customer base that will continue paying its rent. So overall, this stock looks very promising. If you do choose to invest, make sure to do your own due diligence. And if you did enjoy, make sure to subscribe, and I'll see you in the next video. Bye.